Hello, everyone. I'm Amyn Hassanally. For those of you who don't know me, I'm an investment partner at Coller Capital based in New York. Let me start by thanking all of you for making the time to join us today as we present the results of our latest Global Private Equity Barometer. And on behalf of everyone at the firm, I hope you and your families are keeping well as we continue to navigate these unprecedented times. I'm joined today by one of my colleagues, Marnauza, who's an investment partner based in our London office. And together, we will present the results of our latest barometer, which were published earlier this week. Throughout the session, you'll have the opportunity to submit questions. And you can do this by clicking the Ask a Question button, which appears at the bottom left of your presentation window. And we will follow up with you directly after the session with answers to your questions. For those of you who are new to our publication, Coller Capital's Global Private Equity Barometer is a unique snapshot of worldwide trends in private equity. It's a twice yearly overview of the opinions and the intentions of private equity investors based in North America, Europe, the Middle East, and Asia Pacific. This edition of the Barometer captured the views of 111 private equity investors worldwide, and they were surveyed between the 8th of February and the 26th of March 2021. Its findings are globally representative of the LP population by location, by type of organization, by total AUM, and by length of time investing in private equity. This is the 34th edition of Coller Capital's Barometer, and we found that investors are positive about alternative investments generally and private equity specifically, with allocations rising. Investors are looking past the pandemic at long-term investment themes such as climate change, healthcare, and biotech, with a strong focus on ESG. However, LPs are also aware of potential risks to private equity in the new environment we're living in. They're being selective in their re-ups with general partners, while at the same time establishing new GP relationships. With that, let's turn to the findings. Megatrends. Megatrends are long-term structural and transformational changes that impact the way we live, the way we work, and the global economy more broadly. They range from things like climate change and sustainability to demographic changes, such as aging populations or migration shifts, to advancements in technology impacting our healthcare, the way we communicate, and the way we travel. Long-term investors take all of the above into consideration when making investment decisions and investing for the future. In the summer barometer, we asked LPs which of these megatrends are likely to influence their investment decisions over the next 5 years. Two major issues will drive change in LPs' private equity portfolios. 3/4 of the LPs we surveyed say they will invest differently in response to issues connected with sustainability and climate change, and a similar proportion report that they will focus on new opportunities in healthcare and biotech in a post-COVID investing world. Demographic changes and trends will also influence investment decisions for around half of the LPs that we surveyed. Interestingly, fewer LP investment decisions are being influenced by AI, robotics, and the Internet of Things, which ties into our finding that over half of LPs think that there's going to be a correction in tech markets over the next 18 months. Next, we turn to the risks to private equity returns. LPs believe that the risks to private equity returns have risen substantially in the last 18 months. 3/4 of investors fear a worsening geopolitical environment and the potential for trade wars, while over 2/3 are apprehensive about changes in tax or the regulatory environment. In terms of geopolitical risks, the attractiveness of Latin America as an investment destination has diminished for over 1/3 of private equity investors. 1/4 of investors now take a more negative view of the Middle East and Africa as an investment destination for private equity. For China, India, and Europe, LPs' views are more mixed. The number of LPs that view regulatory change and change in taxation as risks to private equity returns has increased substantially in the last 18 months. And it links to our findings on the Biden-Harris administration in the United States. whereas 3/4 of LPs think that the new administration in the United States is unlikely to change the overall operating environment for private equity. 1/3 of North American LPs in particular said that the new administration will likely have an adverse effect on private equity returns. One major concern is the possible change of corporate tax in the United States. That said, another 14% of investors that we surveyed believe that the new administration will have a positive impact on private equity returns. Now let's turn to investors' plans for alternative asset allocations. The chart here shows the net balance of investors planning to increase their allocations to alternative assets is now higher than at any time since the global financial crisis, and it's continuing to climb. And just to be clear, the net balance is the proportion of LPs increasing allocations minus the proportion reducing their allocations. The net balance is positive for all types of alternative investments, with the exception of hedge funds, to which allocations by number of investors is continuing to decline, and that's a trend we've been reporting on for many years now. LP sentiment towards real estate also appears to have shifted, possibly in response to the pandemic. And to put LP allocation plans into context, they're unsurprising when you look at the annual net private equity returns LPs are reporting over the lifetime of their portfolios. Limited partners' returns from private equity over their portfolio's lifetimes are now at a record level. 2/3 of LPs that we surveyed have now achieved overall net returns of between 11 and 15% from their private equity portfolios, with another 1/5 of LPs reporting net returns of over 16% since they started investing in the asset class. Venture capital and buyouts in North America have been the biggest contributors to strong returns. Despite the concerns LPs have over risks to private equity returns, a definite majority of LPs in North America and Europe think now is a good time to be making private equity commitments. It's not necessarily an easy time, however, with over half of the LPs in North America especially saying that it's become harder recently to select the right general partners and the right funds to invest in. The brave new world of post-COVID investing is reflected in a greater willingness among many LPs to change their general partner relationships. 2/5 of investors say they are now more likely to refuse re-ups with their existing general partners than they have been in recent years, and this is primarily because of weaker than expected fund performance. It's also partly as a consequence that LPs plan to speed up their commitments to new GP relationships. The majority of LPs have continued to build new GP relationships at the same pace before the pandemic, and nearly half of the LPs we surveyed plan to speed up the pace of their commitments to new GP relationships over the next 18 months. With that, I'll now hand over to Martins to present the remainder of the findings.
Thank you, Amyn. Sustainability was one of the mega trends highlighted in our first finding, and it is at the heart of the financial ecosystem. Changes in consumer trends impact the profits of companies and how they reward their employees. Company boards are influenced by their investors, who are taking sustainability more seriously, and these investors, pension funds for example, work for the employees and pensioners invested in the funds, which in turn are the consumers. And then there's another level of influence through governing bodies, regulators, and governments, all of whom are working towards building a more sustainable future for the world. It's no surprise then that the limited partners are taking ESG seriously. Half of LPs believe that adopting a robust ESG policy will improve an LP's long-term private equity returns. Only 1 in 10 limited partners thinks that adopting a strong ESG policy would lead to a reduction in returns. Just over half of LPs based in Europe and the Asia-Pacific region believe that some performance-related elements to LP remuneration should in principle be linked to the attainment of ESG goals. And there's a trend in Europe for starting to tie remuneration to ESG goals for LPs. One example is to link proportion of bonus to the achievement of certain UNPRI sustainability goals, but measurement is not easy. Fewer North American LPs agree with this type of proposal, with only 32% believing there should be a link. Investors are also positive on ESG engagement. Most investors believe that although ESG engagement is different in public and private markets, it is equally effective. Engagement in public markets is typically through influencing company boards, where in private markets it is through governance and operational influence, which could be why almost a third of LPs think private equity's model delivers more real-world change. We also asked LPs about how their personal situations had changed since the onset of the pandemic. 2/3 reported that they are happier with their work-life balance than before COVID-19, with challenges of home working more than offset by the advantages of less frequent travel. Interestingly, the number of Asian Pacific LPs that are now happier with their work-life balance than pre-COVID is much higher than the average, at 95%. This is possibly due to the less frequent need to travel internationally to meet developed market GPs. Almost half of private equity investors report that their personal productivity has improved since the pandemic hit. Now, let's turn to the private equity secondaries market. The market has experienced rapid growth over the last decade. However, after 3 years of record growth, the secondary market contracted in 2020 with the onset of COVID, leading to many secondary processes being delayed or cancelled. Transaction volumes did rebound strongly in the second half of the year, and the net effect for the year as a whole was a decline in market volume to $60 billion. Coller Capital expects the secondary market to return to its growth path in the next few years, as investors and fund managers use secondaries to reposition their portfolios for a post-pandemic world, and this is shown in their Barometer results. Three-quarters of LPs are now invested in funds targeting private equity secondaries market, with over a quarter of LPs having more than a tenth of their total private equity commitments in secondaries. And growth in secondaries looks set to continue, with a fifth of investors planning to increase their exposure further over the next 3 to 5 years. And 15% of LPs plan to increase their exposure to secondaries in other alternative classes within the same period. For many years, the Barometer has reported a growth in the number of LPs making co-investments alongside their managers. Last winter's Barometer found that many investors expected changes in LPs' co-investment policies. The current Barometer suggests that this is likely to result in more disparate and LP-specific approaches to co-investments. Although three-quarters of LPs say a desire to allocate more capital to co-investments will be a spur to new policies, they also cite issues such as cost, changed perceptions of risk and return, and limited access as likely to lead to investor reassessments. Lastly, let's turn to private credit. Over the last few years, private credit has seen assets under management record significant growth as private credit fund managers filled the funding gap left by banks following the global financial crisis. And here we see how LPs are investing in private credit. Direct lending, distressed, and mezzanine are all preferred methods for LPs to invest in private credit, with around 3/5 of LPs having invested in at least one and sometimes multiple funds in the last 3 years. However, many LPs believe that the returns from the largest of these areas, direct lending, are too low for their level of risk. That concludes our findings. To summarize, in this barometer, investors are telling us climate change and developments in healthcare and biotech will change LPs' investment priorities. LPs believe the risks to private equity returns have risen significantly. LPs say that strong ESG policies can boost private equity returns, and they are happier with their work-life balance and more productive than they were pre-pandemic. We will circulate this presentation by email tomorrow, or alternatively, reach out to any of the Coller team and we will arrange to send you a copy. The Barometer is a publication of the Coller Research Institute. You can find more information about our reports on the research section of the Coller Capital website. There's also an option to subscribe to our research for future publications. That concludes our presentation. For those of you who have submitted questions, we will follow up shortly. Thank you very much for listening.